What if the one satisfies warning that everyone dismissed as political theater turns out to be the most accurate prediction about where the American financial system is actually heading? This is the uncomfortable question now circulating among economists and market analysts after former President Donald Trump made a series of pointed statements that appear to align with internal stress signals the Federal Reserve has been trying to keep out of public view. The reason this story is escalating now is not simply because of what Trump said, but because of when he said it and what has been happening inside the Federal Reserve System at the exact same time. According to sources familiar with recent Federal Reserve deliberations, there is growing internal disagreement about how to communicate the true state of the central bank's balance sheet and the long-term implications of policies enacted over the past 15 years. Trump has framed this as an exposure moment, arguing that the Federal Reserve is sitting on what he calls a collapse signal that officials are unwilling to acknowledge, because doing so would trigger the very crisis they are trying to prevent. While this language is dramatic, it is not entirely disconnected from what independent analysts have been documenting for months. Filings from the Federal Reserve show that unrealized losses on its holdings of long-duration Treasury securities and mortgage-backed securities remain at historically unprecedented levels, with some estimates placing the figure above $1 trillion. Under normal accounting standards, these losses would represent a catastrophic balance sheet event. But the Federal Reserve operates under different rules and is not required to mark its assets to market in the same way private institutions must. This technicality has allowed the central bank to continue functioning without publicly acknowledging the severity of its financial position. But critics, including Trump, argue that this is not stability, but rather a delay of inevitable consequences. What makes this moment particularly significant is the broader context in which these concerns are surfacing. The United States is now carrying a national debt that exceeds $34 trillion, and the cost of servicing that debt has risen sharply as interest rates remain elevated. Reports suggest that interest payments on the federal debt are now on track to exceed $1 trillion annually, a threshold that was previously considered unthinkable, and that fundamentally changes the fiscal math facing the Treasury Department. Trump has pointed to this trajectory as evidence that the Federal Reserve's rate hiking cycle was not just an inflation-fighting measure, but a structural trigger that has destabilized the entire system of government. Financing officials at the Federal Reserve have pushed back against this characterization, arguing that their mandate is price stability and maximum employment, not the management of federal debt levels. But this response has done little to calm concerns among market participants who see the interdependence between monetary policy and fiscal sustainability as the defining vulnerability of the current moment. The so-called collapse signal that Trump referenced appears to be connected to a combination of factors, including the Fed's ongoing quantitative tightening program, the fragility of the regional banking sector, and the growing signs of stress in the commercial real estate market. Sources familiar with banking sector data indicate that hundreds of billions of dollars in commercial real estate loans are set to mature over the next 18 months, and that many of these loans are attached to properties whose values have declined significantly since they were originated. If these loans cannot be refinanced at current rates, the result could be a wave of defaults that would concentrate losses in regional and mid-sized banks, many of which are already operating with thin capital buffers. This is the environment in which Trump's statements are landing, and it explains why they are resonating beyond his traditional political base. The Federal Reserve has publicly maintained that the banking system is sound and that it has the tools necessary to respond to any emerging stress. But filings and internal communications obtained by financial journalists suggest a more cautious tone behind the scenes, with officials reportedly discussing contingency scenarios that include emergency liquidity facilities and potential interventions in the Treasury market. The concern is not that any single one of these stress points will cause a systemic failure, but that the accumulation of pressures across multiple sectors could create a cascading effect that exceeds the Fed's capacity to respond in real time. Trump has used this uncertainty to position himself as the figure willing to name what others will not say directly. Whether this is genuine insight or political strategy is a question that observers continue to debate. But the underlying issues he is pointing to are not fabricated. The Federal Reserve is operating in uncharted territory, managing a balance sheet that has expanded and contracted in ways that have no historical precedent, while simultaneously trying to navigate a fiscal environment that grows more constrained with each passing quarter. Market signals, including movements in gold prices, treasury yields, and credit default spreads, suggest that sophisticated investors are quietly repositioning for scenarios that are not reflected in official economic forecasts. The divergence between public messaging and market behavior is itself a form of signal, one that suggests the gap between what officials are saying and what they are preparing for may be wider than most people realize. What happens next depends on variables that are not fully visible, including decisions being made inside the Federal Reserve, the Treasury Department, and global central banks that continue to manage their own exposure to American debt. For now, the only certainty is that the questions Trump is raising are not going away, and that the pressure on the Federal Reserve to provide clearer answers is building from multiple directions. The system is holding, but the signals that it may not hold forever are becoming harder to ignore. And until those signals are addressed directly, the fear that something is being hidden will continue to grow, whether officials acknowledge it or not.